Okay, welcome back. Ajay Vora is with us. He's head of equities at Nuvama Asset Management. Ajay, good to have you with us here. Thanks very much. I mean, of course, not to ask you about your stock, but it's been an absolute, what can I call it, banger. 60 rupees in earnings, very, very strong growth, and wealth management is doing well. I mean, and I was looking at some estimates which suggest that even after the very strong performance we've had, the P multiples in FY25 are in the 20s. If you, of course, consider that markets, etc., stay pretty solid. What's your view about the space? Not about Nuvama itself, because I know you can't comment about it, but on the wealth management as a space.
Hi, Prashant. Good afternoon, and thanks for having me on the show. So you're absolutely right. So, I think, wealth management is a subset of what is happening at a larger theme. And I think the bigger trend, what is playing out in this country is the wealth effect. And you need to pick and choose the subsectors which will benefit because of this theme. And obviously, the wealth managers are participating this in a very big way, and they're at the front end of this whole theme. Because as and when, more and more people are getting wealthier, as we all know, people are looking for more sophisticated products, diversification into different categories. And the only way where investors can actually get access to these kind of products is through wealth managers. So eventually, just like any other business where the distribution becomes the core to grow your business, similarly, these wealth managers is at the core of any financialization of the savings. So I think that, the trend is very strong. And, apart from that, if you look at other themes also within this large theme of wealth creation, you look at real estate or you look at travel as a theme, they are also doing exceedingly well. So I think the way when I talk to investors, I would generally, recommend not to look at, more of index where it is heading. But it is the trends which are playing out in this country and the subsectors which can benefit because of this whole large wealth creation theme, which is one of them.
Jay, if markets were to see a bit of a shakeout, how does that affect wealth management companies? I mean, if there were some redemptions or whatever, we don't know. If there is a bit of a, not a very sharp pullback, but a 5-10% kind of a correction, does it have a direct impact?
So I'll tell you that, obviously it does have an impact. So there are two parts to it. One is the MTM. So, we talk about the AUM under advisory, which works more on new flows as well as the, MTM that gets impacted. And secondly, people may hold on to their new investments. But at least, from my interaction with the investors, what I've realized is that at least if you look at equity as a whole, a lot of investors are looking for some pullback since a very long time and are looking to deploy into different products. But unfortunately, market has been trending up, almost for last 6, 7, 8 months. And people have been on sidelines, although they have participated, but I think not wholeheartedly what they would have participated. And therefore, even at lower levels, just like what you saw during the election time, incrementally, we are seeing a lot of inflows. So my sense is that, it can be a knee-jerk reaction, but investors who are looking at this theme are having a view of at least, I would say, 3 to 5 years. And therefore, the wealth managers' overall size also, if you look at it, the market cap of 2-3 players put together, it's less than $10 billion right now. So my sense is that the opportunity is pretty large and not to get swayed away by the near-term movements.
Ajay, but at Nuvama, what's the call? Is a shakeout in the market coming, perhaps in the next 6 to 9 months? Do you foresee a significant correction, one that we've not seen in a while?
So, Reema, the thing is that, everyone has been talking about a shakeout and a correction since a fairly long time. And I think people have lost more money staying on sidelines rather than participating in this. So the way we are looking at this is that, all the large events are behind us. Globally as well as locally, now we are entering into a period where, globally the rate cycle may start. Locally, if you look at it, election was budget and election, both were the biggest events which people were worried about. They are behind us. But at the same time, I would say that, not much may happen at the index level, because if you look at FY26 earnings, which is expected to be around 1250 rupees EPS for Nifty, Nifty is trading at around 20 times at an aggregate level. And even in this quarter, so far, the numbers, which has come out, there has been a little bit of disappointment versus the expectation. So my sense is that, at index level, not much may happen. The compounding can continue at around 10-12%. But I think the money-making opportunity is more at the broader level, broader themes, the bigger trends which are playing out across, market, be it manufacturing, be it, exports of goods, or as we discussed about real estate and a couple of other themes. And I think that is where one should focus on.
Hi Ajay, good afternoon. Good to see you in. What do you make of this recent announcement on the real estate theme? They've gone ahead, they've cut the tax rates a little bit, but indexation goes out. You were positive on real estate, so I ask you this. What's your current view?
So, Nigel, we continue to maintain a fairly positive and constructive view on real estate. I think that, it definitely opens up an incremental avenue for people who have that excess liquidity. With the duration of holding coming down to 2 years and the taxation coming down from 20% to 12.5%, it definitely opens up one more asset for the investors to diversify, whoever are not holding it. Obviously, people who have bought in from 2001, there is an impact because of indexation going out. But I think if we take a fresh look from here on, there would be definitely a large part of the investors who would look to diversify now into real estate. And more than investor community, I think that the end user, as I discussed, the wealth creation impact, I think real estate is at the front of that whole opportunity. And my sense is that, lot many households are yet to upgrade. And as and when their portfolios or the wealth increases, most of the families would look to, buy a new house. So my sense is that the real estate theme is not a 2-3 year theme. It is here to stay for a longer period of time. And therefore, we maintain a constructive view over there.
About that, Ajay, so you think the good times have only just started in real estate. What else? I mean, where else do you see, value is a very difficult term to use in a market like this, but where else do you see at least reasonable prices where one can expect, reasonable growth to come in as well? Give us some more themes, anything new on the horizon. And by the way, we'll have a brand new segment opening up with the Ola Electric now. First of its kind, pure play EV sort of theme to back. Thoughts here?
Yeah. So Surabhi, actually, we are fortunate enough, that our market at any point of time throws up n number of opportunities. So I think that as money managers, we are fortunate that we don't get stuck with a particular theme, and therefore, you keep looking for themes. Eventually, you'll end up getting many such opportunities. So one such, I would say a trend or a theme which we are working on and we are pretty constructive are the companies on the manufacturing side which are nearing their overall capex. So if you look at tires as a segment, they have been into this whole capex mode for last 2-3 years, and more or less by this year or next year, mid of next year, they'll be done with their whole capex. And if you look at the valuation versus all other auto ancillary, they are trading at 2x kind of a valuation versus the tire companies. And if you look at, the way crude is behaving over last maybe few weeks or so, and going forward also, we are not very positive on crude prices. If that stays lower, the margins which most of these tire companies will make, and therefore the valuation which they're trading at right now, I think there is a significant money to be made on this whole tire space. Similarly, the second theme, which we are extremely positive, and we have been, on the right side for a fairly long time now, almost a year or 18 months, is the whole OMC space. I think if you look at, or if you listen to the HPCL con call also today, they have been very positive on the outlook. And, they are nearing their completion of the large part of their capex by end of this year, which will add to a lot of, efficiencies and improve their refining margins by almost $3 to $4. So my sense is that, if you look at the ROEs of all these companies over a longer period of time, say 8 to 10 years, they have been doing 20% ROE. And if you do the math and put in all the numbers, these companies with a 20% ROE are trading at less than 10p or maybe 5 to 6 times EV to EBITDA. My sense is that over here as well, a significant money can be made over next 1 or 2 years.
Actually, IOC has just reported the Q1 numbers. It's a miss on revenues, it's a miss on margins. But as Ajay was pointing out, perhaps the outlook is better. Even for HPCL, if you remember, Q1 was a miss, but the outlook in the subsequent quarters with respect to the GRMs, given crude prices have fallen by nearly 8% in the month of July, is far more robust. So IOC too, it's a miss in Q1. We'll await Sonal. She'll join us in just a bit. But I think the stock is holding up, still up, close to about 1.5%.
Absolutely. Actually, Ajay, just come in with some more detail on this, because everyone was trying to wrap their head around it, because on HPCL, that under-recovery picture was really ugly on LPG, right? Almost 2,500 crores of under-recoveries, and God knows whenever they get the money in from the government. So is it that you're just expecting that a company like HPCL is nearing the end of the capex cycle and therefore ROE will improve? What else is the trigger? One trigger is, just crude. So it could be a great trading play as well, because the price was below 80 in the morning. Just explain more on why you still like oil marketing companies.
So just if you take the example of HPCL, and they clarified on the con call as well that the LPG under recovery which had played out in the current quarter, they are pretty hopeful of recovering that from the government at least by end of the year. So that was one major clarification. Secondly, if you look at it, that they have been talking of demerging their entire lubricant business. Now, if you look at their lubricant business, that is 3x the size of Castrol. Although the mix is different in terms of B2B and B2C. But today, if you look at Castrol's market cap, that is somewhere close to 27,000 crore. And HPCL market cap is somewhere around 85,000 crore. So I'm not saying that, like to like, there can be a similar market cap assigned to the lubricant business for HPCL. But whatever math, if you end up doing, and if you strip off the entire lubricant business and then you look at HPCL on a standalone basis, there is a large part of investments also into other companies. So if you strip off all those things, company has officially guided for around 40,000 crore of EBITDA by 27-28. And therefore, then if you do the math, these stocks are trading at around, I would say, anywhere between 3 to 3.5 times EV to EBITDA. So my point is that once you have the capex completing, you will have a significant cash flow generation possibility going forward. And especially when the GRMs are likely to improve because of their newer capex, these stocks are looking pretty cheap. So therefore, we can talk about, the other two companies as well. But I think this whole space, because of the factors which we discussed, is looking interesting.
All right, Ajay, we'll leave it there. A great chat as always. Thank you very much for joining us. It's a pleasure as always. The market's cooled.